My guests today are Hugh McDonald and Mike Comparato. Hugh is the head of client capital management at Clarion Partners, and Mike is the head of commercial real estate at Benefit Street Partners. Both are subsidiaries of Franklin Templeton. With $1.4 trillion in total assets under management, Franklin Templeton is one of the world's largest independent investment managers. So today we're going to be talking about private real estate investing from both sides of the equation, equity with Hugh and the debt side with Mike. So gentlemen, welcome. Thanks for joining us today, Hugh and Mike. And Hugh, maybe I'll start with you. And of course, you focus on equity investing, and Clarion has a 40-year history of that. And it's one of the largest pure play real estate investment managers with over $75 billion in assets under management. So you have excellent perspective, both of you do, on the state of the commercial real estate. And so that's where I want to start. Because if I look at some of the price charts for the corrections in commercial real estate, the index is down 16% from the peak in price appreciation terms or depreciation terms since the peak in the second quarter of 2022. And when I last looked at the chart about a quarter ago, that number was 11. So it seems like the returns still continue to be negative. But where are we with the state of commercial real estate? When might we see a turning point?
Well, thanks, Anastasia. 2023 has obviously been a super complicated year for commercial real estate broadly. The significant movement in the Fed created a lot of volatility in the market, affected, the pricing of core and other forms of real estate. So, been a very, very complicated year. I think the outlook going forward is much different, both on the equity side and on the debt side, right?
But net, do you think you see more opportunity in commercial real estate given the correction, or do you think the risks are still lurking?
We're definitely at the beginning of a new part of the real estate cycle. There's overall more opportunity, and we're excited about that opportunity for sure. Again, there are risks and places that risk will create opportunities in capital structure, but overall the outlook is very good. Remember, private real estate has performed very well over a very long time period in portfolios. So it has delivered exactly what it was supposed to deliver. Good returns, 8 to 9% over long time periods, low correlations to equity and debt, low volatility. So all of those good factors about private real estate, we're about to see again as we head into the next part of the real estate cycle.
All right. Well, let's take the other perspective on that from the debt side of the equation. And so, Mike, from your perspective, where are we in terms of this commercial real estate cycle? What kind of opportunities is this creating to be a lender in this space?
Yeah, well, thank you again, Anastasia, for having us. I think picking bottoms is a very dangerous game, but I do think that if we're not at the bottom, we're very close. I think it's a little bit more difficult in the office sector. What we're seeing in the office sector is a fairly apocalyptic correction.
That's more like a 27% correction, by the way, not the 16 I referenced.
And I think that's probably conservative, would be my guess. I think it's probably meaningfully more than that. I think commercial real estate has really gone through a phase right now of there's office and then there's everything else. But it's been a very difficult time. But what it has produced on the credit side of things is really a dislocation in the credit market, given how heavy a role the banks play in commercial real estate credit. They represent about half the market. It's about a $6 trillion market. Banks have about $3 trillion of that. And they are largely on the sidelines. They have not been lending for the past 12 months. So we are taking advantage of the banks being on the sidelines. We're taking advantage of the mortgage REITs, publicly traded mortgage REITs, being on the sidelines. And we're achieving what we believe to be some of the best risk-adjusted returns in the lending space that we've had since the GFC.
Right. And you brought up the GFC, but there's another banking crisis we should talk about. And by the way, as we sit here this week, it's a 1-year anniversary of the unfortunate collapse of Silicon Valley Bank. And we've got New York Community Bank that is also in the headlines as well. So are those one-offs? Is there a broader crisis to be thinking about and that can derail commercial real estate?
I don't think we can derail commercial real estate. I do think we are in the throes of a banking crisis. I think it's probably more touching more the community bank and regional bank sector than it is the large money center banks. But they haven't been lending for a year, and that's not because things are good at the bank. Remember, commercial real estate mortgages are non-mark-to-market assets. I think if you had to mark a lot of their paper to market, you could have hundreds of insolvent banks, but they're hoarding their cash. They're going to try to fix their problems before they start actively lending again. And I think it could take a few years before we see that happen.
So, Mike, everybody knows it, but Hugh, if everybody knows this, and Mike paints, I think, a realistic, but also a bit of a pessimistic, state of the banking crisis. But how does this end? How does this end for the commercial real estate investor?
The fundamentals in commercial real estate at the asset level are actually pretty good in all of the sectors, or most of the sectors.
And that's when we look at vacancy rates and...
Right, by fundamentals, right? Vacancy rates, occupancy, vacancy, rental rates, et cetera. So the fundamentals are actually really good in all sectors apart from office. The pandemic taught the world how to work from home, and that has changed how people think about working in an office environment. And today we see what we see today is when people are taking space, they're taking 15 to 20% less space. That has the apocalyptic, to use Mike's term, impact on office demand. So let's put office to the side for a minute, and the rest of the sectors are really good. And by the way, office, which used to be 30 to 40% of portfolios, is now like 15 to 20% of portfolios. So it's becoming a much smaller part of institutional investors' portfolios. Industrial warehouses has had a terrific performance run over the past decade and is projected to continue. Housing has a very significant positive outlook. There's a significant shortage in housing in the United States, 3 to 5 million units. That's spread across different formats, from manufactured to student to traditional to high rise to senior, right? There's a shortage of housing, and that's a big tailwind. And then other sectors, things that people don't often think about almost as real estate sectors, things like storage, self-storage units, which have traditionally been a part of the public domain but not the private domain. Those are increasingly becoming institutional. And the outlook for all of those sectors on a go-forward basis is really, really good.
All right. So more about office, but I think we understand that the profile of office is quite different. And so that's why, Hugh, you're focusing on things like storage and housing and warehousing and some of the more alternative subsectors. But Mike, back over to you. As you look to be the lender in some cases of last resort and to fill in the funding gap that's been left by the regional banks, where are you stepping in? Where are you seeing the best opportunities across sectors, across different companies?
The assets are performing. Hotels are great. Multifamily is great. Industrial is great. All the things that Hugh pointed out. This is really more about fixing, over-levered properties and just getting through that correction process on price. But where we're trying to take the most advantage is, where the banks have stepped back the most. So we talked earlier about banks being about 50% of the overall credit market. They represented probably about 95% of the construction loan market. So we've seen the construction lending market come to a virtual standstill. And we've been trying to take advantage of that, lending mostly, I would say, in multifamily and also in some industrial construction, but writing what we believe to be some of the best risk-adjusted returns in construction lending that we've seen since the GFC.
Right. That's a significant opportunity to step in. My last question to both of you, when we take a step back and reflect back again on 2023, everybody knows this again, that it's been a very slow fundraising year. If you look at the fund flows into commercial real estate funds, we've had the slowest year of fundraising since 2013, so in 10 years. So Hugh, my question to you is, when is the time you think that investors are going to say, you know what, I want to re-engage with the asset class, or when do you think they should?
So I think that is actually starting now, and I have been surprised by the volume of interest from investors in doing underwriting and looking at real estate, private equity real estate products across the spectrum. So, and what we've seen is institutional investors starting to do the work so that they are ready in the first couple of quarters of 2024 to re-enter the market.
It begins now. Mike, what do you say?
Look, I think Hugh and I are both fundamental believers in the long-term investment of commercial real estate. There's going to be periods where equity outperforms credit outperforms equity, and vice versa. The real goal here is to have the exposure to the asset class. It's a great diversifier, and as Hugh said at the very beginning, over the past 4, 5, 6 decades, it's really been a very stable performing asset class and should continue to be in the future.
Right. Thank you for your terrific insights on both sides of the equation. And what I especially liked about our conversation is that we did address not only the equity side of commercial real estate, but also the debt side. And if I'm an investor in commercial real estate market, I need to understand that I may have opportunities across that entire ecosystem, even if one part of it may not be most optimally positioned. And so, my takeaway is, Mike, as you say, you're stepping in and you're providing capital and you're seeing probably some of the best opportunities or the number of opportunities that you've seen since the financial crisis, and that's terrific. And Hugh, it sounds like the valuation correction may be running its course and investors are looking to step in and buy some of those good properties at better prices. So with that, thank you both for your insights. Thanks for joining us today.
Thanks, Anastasia.
Thanks for having us.
Thank you.